time. It is episode number 15 of the Traders Podcast. I am your grateful and appreciative host, Jeremy Ritz. Super excited that you're joining me back here for another episode. Hard to believe that we are 15 in to this podcast that I started this year as part of Courage Pays Better Than Fear Trading. And I'm very excited to be here with you today. The lovely month of April, where it appears that the market has entered correction territory. We've been on a big bull run since the end of this past October, and really things were flying so high January, February, even into March. And now we're getting that pullback, that correction. And today I'm going to spend some time talking to you about what exactly a correction is, as defined by, just Googling, all right, what's a correction? What that basic information is from a number of different financial sites you could visit and check out. But I'm also going to approach it from what is known as Dow theory. And Charles Dow, who used to be a writer, a researcher for the Wall Street Journal back in the day, his collection of essays. And while he never explicitly stated, this is my theory, this is my philosophy, what people did was extract from his writings what is known as the Dow theory. And he talks about corrections. He calls them secondary reactions. And we're going to look at what a correction means through the lens of a secondary reaction as well. And that will give us a better understanding that as we go through this pullback situation, how far it can pull back. When does it pull back too far and we change the primary trend from bullish to bearish, if that would in fact happen? And how long could we expect this to last? So that's what we're going to get into today. All of that and more, plus the Ask a Trader segment. And we're going to check on Mr. Roku, see how he's doing. But before we get into that, just want to announce, a couple new courses that are going to be coming your way. We're going to have a day trader boot camp that is going to be popping off in June. I'm going to have an immersive one-day beginners trading boot camp sometime in May, where instead of doing this over the course of 4 or 5 nights, you sign up for a day. I go through it all so you can knock it out in one go. So rather than doing a full week, you can knock it out in a day and, get an opportunity to win a funded account. So that will be available to you. And I'm also going to have an active investing course that's going to be coming your way. So stay tuned for information on all of those courses as we move through the month and into May. I'll have more information, but wanted to put that on your radar. Okay, and without further hesitation, for episode 15, let's jump into Ask a Trader. All right, hopefully you enjoyed that little bit of guitar playing. And we're going to get into the Ask a Trader questions here. And someone commented about how they enjoyed me sharing the Trader's Almanac and asked if I had any other book recommendations. And I actually do. And it's one that I'm going to talk about here today. And it's called The Dow Theory. How fitting, being that we're going to talk about corrections. It's by Robert Ray. But this goes into the specifics of Dow's philosophy from all of his writings back with the Wall Street Journal. If you enjoy trading and the markets and you want to understand trends, how they correct, how long they typically last, this is the classic, man, right here. The Dow Theory. You can find this on Amazon. It's relatively cheap. Robert Ray, RHEA. Check that out. That's a recommendation that I would provide to anybody out there who is interested in learning the markets and developing mastery over the markets. Check out the Dow Theory. Question number 2, Jeremy, this is a very choppy market that's very different from the bullishness that we had at the beginning of the year. How do you trade it? And so I'll tell you, it's been a little challenging here these last few weeks because it hasn't really stuck to a trend where we're just kind of locked in bullish or we're locked in bearish. It's been a lot of this, right? Up and down, up and down. Today's the perfect example. Today is Wednesday. What is it? April 17th. This morning, everything was up, was moving bullish, and it looked pretty promising. And then, boom, big sell-off on the SPY, on the Qs, really everything. And again, there's a lot of uncertainty in the markets right now as a result of high inflation, the Fed saying that they're going to hold rates higher for longer. We'll probably still get those rate cuts, but later in the year. But then also too factoring in the military issues going on between Israel and Iran, that's really impacting everything. And the markets don't like uncertainty, and so they're very sensitive to news. And what you're seeing is you get one piece of positive news that may pop things, and then something else negative comes in, drops it, and it's just back and forth. So until we really settle into a trend, it may be a little bit difficult to trade. Now we are in a correction, so the edge right now is bearish, but who knows how long that will last. We'll talk about that a little bit more when we get into corrections. But, in choppy markets, when it's these wild swings, just wait for the right setup. Don't be a rush to jump into a trade. Wait for the right setup. Take your time, protect yourself, get in. And there's nothing wrong with not trading. Sit on the sidelines and wait till you have an edge. Why trade something that you don't feel supremely confident about? So that's how you approach a choppy market. There are strategies that you can use for choppiness in markets with options. Sign up for my options class if you want to learn how to do that. But if you're a trader, just wait it out. And then lastly, the final question: what is your long-term forecast for the market through the end of the year? And this is a great question. And what I will say is, we've been bullish since we got out of the bear market of 2022. And it's been a tremendous start to this year. We are getting that correction, which again is completely healthy and natural. But what I see after this correction taking place, getting closer to the rate cuts happening, assuming inflation data is coming down, I think we're going to see another push higher that's going to take out the highs on the SPY and the Qs. You're going to have a lot of the other big tech stocks pumping. We'll eventually get small caps involved in this rally once there's some certainty around rates coming down. And I think things will push into the election. And then what I see happening is once that election is complete in November, then I think you'll see another correction and maybe a bit of a pause before the market decides what it's going to do next. So right now we're in a pullback. We're waiting things to get to value areas before going long again. So we're looking for short opportunities right now. And then in maybe 1 to 3 months, depending on how long the correction lasts, we'll resume bullish. And then, like I said, I think around that November time is where we'll see another correction and probably some pause and hesitation as the market digests what has happened in the election and where we're going to go from there. So that's how I see it. Again, that's not financial advice. I'm not telling you how to approach the markets. That's just how I see things. And we'll see how it plays out. But what we're going to talk about today, what is a market correction? All right. And again, it's been no surprise for me to tell you that the market has been bullish. It's been on a massive run. If you go and look at the charts on the SPY and on the Qs, go look at NVIDIA, super microcomputers, it's done this. It's gone straight up. But what must happen in every market is any bull market is you need to have a correction. And what a correction is, it's a pullback. It's where people take profits from that massive run and you see the price start to come down. Now, a lot of people, when they see selling come in like we're seeing now, they become fearful. They think that the market is going to crash, that it's going to go to zero. But in fact, this is a healthy component of a bull market. And you need to have corrections in order for the run to continue. And before this bull market makes its next leg higher, which it will, it's got to pull back and it's got to correct. So how do we define a market correction? Well, there's two ways to look at this. If you just do a general Google search for a market correction, what you're going to find is it is defined as a 10 to 20% pullback, right? Pullback being from the highs that ticker has made, it's going to pull back 10% in that price or 20%, right? So a 10% drop or 20% drop, that is the correction. If it exceeds 20%, potentially there is a change in trend, and you could assume that we are moving into bear market territory. So you have to watch that 20% range. Okay. So that's one way of defining a correction. Now, I was talking about Dow theory. Okay. There's a different way to look at corrections from the perspective of Charles Dow and Dow theory. And again, the corrections in his terminology are called secondary reactions. So your primary move is your main trend. So right now we are bullish, but what we are getting at this moment in this primary bullish trend is a secondary reaction where we are pulling back. It's a correction, okay? And according to Dow theory, a secondary reaction, correction, whatever you want to call it, will be either 33% or 66% decrease since the end of the last secondary reaction. So you have to find that last secondary reaction in a bull movement, look at the high that's made after that, and then figure out what 33% of that move is, and that's how much you should pull back, or 66%. Okay? So you can use either of those definitions. The 10 to 20%, that's your typical correction that you'll find in most financial websites if you go and search that on the internet, or if you're looking to this according to Dow theory, you're finding that last secondary reaction, the last pullback, which ended at the end of October of last year. And then you find that next high, which we made in March, and you're taking 33% of that move and figuring out what that pullback is in 66%. So 10%, 20%, 33%, 66%. That defines a correction. So you can see a pretty significant move back, and it's still completely healthy. However, when you go beyond that, when you push lower, then potentially the trend has changed and we have shifted out of a bullish trend into a bearish trend. Okay. So while you're seeing things selling off and you're seeing these big, massive red candles, these big selling candles, and you're hearing all the doomsayers saying things are going to zero, the market's going to crash and all these things, you know that this is a healthy part of a bull market. The same is true for a bear market. When you're in a bear market and things are going down, guess what has to happen? A correction, 10 to 20%, or according to Dow theory, 33 to 66% of the move from the last secondary reaction. Okay, so now you can, when people are talking about the stock market and they're saying, oh yeah, things are in a correction, you can be, yeah, I wonder if it's going to be 10 or 20%, or, if we're looking at this from the Dow perspective, 33 to 66%. You could be educated on this subject, this topic, and go check out your trading view, pull up the ruler, measure it out, and see for yourself where we are and how much we need to go. I will tell you that we have quite a ways to go to have a full correction, but keep this in mind too about this bullish move that we've had. There really hasn't been much of a pullback. So we could have a 7, 8, 9% pullback correction, and then we move higher. So it doesn't necessarily have to be 10 to 20%. It could be less, but the reality is that's where we are right now in the markets. Now, the one last thing I wanted to point out, when we talk about bull markets, one of the questions is, how long does a bull market last? Well, on average, a bull market typically lasts about 2,069 days, right? On average. So historically, if you go back and study the S&P 500 from its inception, 2,069 days. Bear markets, on the other hand, guess how much? I can't really hear you. I'm pretending like I can. 446 days. So you could see that primarily the way that the market moves is bullish versus bearish. Now, keep this in mind. For corrections, according to Dow theory or secondary reactions, they last anywhere from 3 weeks to 3 months. You could say, let's just say, for instance, that the correction began last week in the markets. According to Dow theory, 3 weeks, that will put us through the end of April. Potentially, we can start moving back up in May. Or if we go 3 months, that puts us into July before we start moving higher. And if you go and look at just the general market correction, how long they typically last, you'll see on average between 1 to 3 months. Okay. So from 3 weeks to 3 months, 1 to 3 months, that tells you how long we can expect this correction to last. Okay. So there you go. Now you know all about market corrections. You understand why we're in what we're in, and we'll see how long it's going to last before we start making our next leg higher in the markets. And now it is time for us to take a look at Mr. Roku. And Mr. Roku continues to ride the struggle bus And here we are. Oh, man. I mean, this thing. So here's what I will tell you. Notice this right here, April 25th. That's next week. Next Thursday, they are going to report earnings. We'll see how that comes out. But look, 1, 2, 3 red days in a row. You're getting a little bit of buying that's coming in place right now. And notice how these lows are almost equal. These can be referred to as tweezer bottoms. And that could be a reversal signal, right? When you have a low that's made, this lower wick nearly aligns perfectly with the lower wick of this candle if this ends up holding. And this could be a reversal signal that Roku is going to start to bounce. Now, I'll believe it when I see it, because if you just look at how this thing has been waterfalling since its last earnings, there's just not been anything positive here to talk about when it comes to Roku. And you could see that moved down from this lower wick to where we got to today, $33.66. So 36%, right? That's bear. This is a bearish stock. This isn't a bearish trend. It needs to change. Okay. And it hasn't even really gotten a secondary reaction. It hasn't got a bounce. But what we're seeing is that the trend line that existed, that broke, and then it came down, it tested those COVID lows, it bounced, and then it got below those COVID lows yesterday, and we're still below those COVID lows today. And it just doesn't look good. Volume is weak. There's not a lot of interest in the stock. And when you pull up the headlines here, you're seeing that there were compromises in terms of Roku's data. So user information was compromised, it was breached. And, that's not good for the stock. You could see that there were lots of downgrades on Roku. These are companies that said, let me see here. So here's a downgrade on the stock from 65 to 60. So saying that it's only valued at $60. There's one that dropped it to $40. Let me pull that one up. Well, here's one. So it went from 66 to 56. And there was one that dropped it to $41, and I can't find it. Let me see if I could find it here. Let's see if I can find that. Might not be. There it is right here. So Wells Fargo. So they dropped their price target from 51 to 45. So the overall news on Roku is not good. The outlook is not good. So, I mean, this eventually it's going to bounce, right? That's what we keep telling ourselves. The low, its most recent low, 5509, that was this past October. Could we come down and retest that? Potentially, but it's got to make a move. Now, the higher interest rates for longer is not helping the stock, but earnings is a big day for it next week. So we'll see how it comes out. And what I'm anticipating right now, can it gap lower? Geez. I mean, it's so oversold. I don't want to say that it can't happen, but I think that just the move that we've had down, it's in such a value territory that I think we get a little bit of a gap up on earnings next week, but we'll see. And I don't know if we will. I'll try to record after earnings, but if not, I'll end up doing it before. But regardless, we'll have a lot to talk about. Remember, we have these gaps to fill here and here. Can it do it on earnings? Maybe they'll have some big surprise. We're going to find out. And that will be next week, next Thursday. So that's going to do it for episode number 15 of the Traders Podcast. I appreciate you guys so much. Jeremy Newsom will be coming on the show the week of April 30th. So stay tuned for that. We're going to talk about his brand new book that I just finished reading. It's fantastic. We're going to discuss that and more. Really dig into the trader's mindset and Jeremy's story. And again, Jeremy was my coach and helped me learn everything that I know, put me on the path to where I am today. So I'm tremendously grateful for him. So I'm excited to have him on the show. And then I have another guest that I'm working on to come on, another trader investor that I really look up to admire. So stay tuned for that. But in the meantime, have a phenomenal week trading. Go share your knowledge about market corrections with your family and friends. And I will see you back here next week for episode number 16 of the Traders Podcast. Take care, everyone.